Every time a market crashes, millions panic, but a tiny group always gets richer. And here's the thing that many people misunderstand. They don't get rich despite the crash. They get rich because of it.
Every crisis in modern U.S. history, 1929, 1987, 2000, 2008, 2020, has followed the same wealth transfer blueprint. And today, while America is at the door to the next crash, some of the richest investors in the world, people like Warren Buffett, Jeff Bezos, Mark Zuckerberg, Michael Burry, are already repositioning. That's because they understand market crashes are not random chaos. They're mechanical events with predictable winners. And if you know what those winners do, you can copy the same principles on a smaller scale and come out wealthier than you've ever been. In this video, we'll break down 5 factors that cause a market crash, 3 strategies that billionaires use to preserve wealth and gain profit, and 5 steps how you can copy these strategies yourself. By the end, you'll see the entire blueprint clearly. It is then up to you to decide whether the next crash, the one forming right now, will destroy your wealth or launch you forward a decade. Let's begin. Part 1. How market crashes always follow the same pattern. Most people think market crashes are caused by fear. They're wrong. Crashes are caused by math. When prices exceed fundamentals, when valuations stretch far beyond earnings and everyone becomes overconfident, a crash isn't a possibility, it's an inevitability. This has been true in every major American crisis. The 1929 crash, the dot-com bubble, the 2008 housing collapse, the COVID-19 liquidity crash in 2020. The surface details change, but the underlying math never does. Here's the cycle billionaires watch. Number 1, excessive optimism. This time is different. It's never different. People said it in 1929, when stock prices climbed 300% in 5 years. They said it in 1999, when companies with no revenue doubled overnight. They said it in 2006, when anyone with a pulse could get a mortgage. Every major crash in American history begins with the same euphoric blindness. Number 2, silently rising leverage. People borrow more and more money to chase bigger investments. And when enough leverage builds up, even a small drop becomes dangerous. Why? Because borrowed money comes with rules. If prices fall, lenders demand more collateral or force investors to sell. That's how leverage quietly turns a normal downturn into a crisis. Which is exactly what happened before Black Monday in 1987, when portfolio insurance strategies multiplied selling pressure. Number 3, a trigger event. Be it a bad earnings season or a geopolitical shock, the trigger doesn't matter. What matters is that it starts forced selling. In 1929, it was tightening liquidity. In 2000, it was earnings misses from overhyped tech companies. In 2008, it was failure of more and more risky loans. Different triggers, same mathematical outcome. Number 4, the cascade. When leveraged investors lose money, they face margin calls. To avoid bankruptcy, they sell. This is why crashes always feel sudden. They're not slow declines, they're liquidations. It's what caused the fastest 30% drop in history in March 2020, a liquidation spiral amplified by leverage and derivatives. Every sudden crash is actually a long fuse with a short explosion. Number 5, maximum fear and maximum opportunity. At the bottom, the market is not priced for fundamentals. It's priced for fear. And billionaires buy right then and there because math tells them everything is on sale. Rockefeller bought aggressively after 1929. Buffett went bargain hunting in 2008. The richest investors don't fear crashes. They use them to their benefit. And now we transition to the real question. How do billionaires position themselves before this cycle even begins? The answer is not complicated, but it requires system. Let's break it down. Part 2. What billionaires do before the crash. There are 3 moves billionaire investors consistently make long before a crisis hits.
You saw hints of these moves in 2008, 2020, and in 2024 to 2025. They're simple, they're logical, and they're extremely powerful when executed together. Let's go through them with real evidence. Strategy number 1, building massive cash positions. Before every major market crash, the world's richest investors do something very specific. They quietly reduce risk. Not by dumping everything or panicking, but by easing off exposure and building cash while markets still look calm. Take Warren Buffett's company, Berkshire Hathaway. As of end of 2025, Berkshire is holding more than $380 billion in cash and cash equivalents, its largest cash pile ever. Jeff Bezos, over 2024 and 2025, sold massive amounts of Amazon stock under prearranged plans, raising many billions in cash. And Mark Zuckerberg has sold large chunks of his Meta Platforms holdings this year, repeatedly, converting equity into liquidity. Why does this matter? Because when markets fall 30, 40, or even 50%, cash becomes ammunition, the dry powder to buy assets at discounted prices. Billionaires don't wait for panic, they prepare for it. Strategy number 2, buying wealth-preserving assets. To preserve purchasing power, a portion of the billionaire's portfolio gets moved into hard assets, debt instruments or short-term securities, as well as high-quality income-producing businesses. And of course, precious metals like gold, the favorite of many billionaires such as Ray Dalio and John Paulson, who in times of crises relied heavily on gold and similar assets. And the same is true today. Dalio recommends investors to allocate up to 15% of their portfolio into gold, and Paulson is reported to be among the biggest holders of gold and gold mining-related assets. The idea isn't to chase explosive returns, but to stabilize and protect capital. Strategy number 3, buying hedging instruments to profit from downside. This is where things get asymmetric. They don't just protect, they profit from market stress. By buying hedges, puts, volatility instruments, and credit default swaps, they position for large payoffs when things go south. Take Michael Burry, who recently made headlines by purchasing put options against overvalued tech names such as Nvidia and Palantir, preparing for a broad market drop. And who else to take an example from, if not from the guy who became famous by going short in 2008 housing market crash and earning hundreds of millions for his investors. Together, these 3 moves we just looked at, cash buildup, partial shift to stable/hedged assets, volatility hedging, create near-ideal crash-proof positioning. If the market declines, the newly acquired assets become ammo, or profit. But here's the good news. You don't need billions to copy this model. Let's look at how you can do it with any amount of money. Part 3. How normal people can copy the billionaire blueprint. Here's how you apply the same framework, even if you're working with a few thousand or even a few $100s. Step 1. Build your crash ammunition. No, you don't need 50% cash like a mega fund, but you do need usable liquidity. Aim for 15 to 25% of your portfolio in cash, high-yield savings, treasury bills, or money market funds. This isn't about timing the market. It's about being ready. When everything is on sale, you want cash, not regret. Step 2. Add a small allocation to wealth protection. Having assets that historically hold value well is what will keep you in the game when markets panic. And for everyday investors, that might look like 5 to 10% of the capital in gold or a gold ETF, other hard assets, short-term bonds, or high-quality fixed income. These aren't growth bets, but the things that will make your capital much more stable. Step 3. Use small, affordable volatility protection. You don't need Wall Street-level tools, but just like when billionaires take bearish positions on certain stocks and get positive returns during crises, you can achieve similar results by buying simple protection, like long-dated put options on broad market ETFs. Small volatility-related ETFs or funds, as well as inverse ETFs, which, however, have to be handled with caution in the long term. Keep in mind that you don't need a lot. Even 1 to 3% of your portfolio in long-dated puts can cushion the crash, provide cash when markets fall, and give you psychological calm when volatility spikes. Think of it like home insurance. You hope your house doesn't burn down, but you wouldn't risk by having it uninsured. Step 4. Prepare your buy list now. Crashes don't give you time to think. Bottoms are violent and fast. So before the crash happens, you need a list of quality ETFs, dividend stocks, index funds, cash flow assets, and strong companies that you believe in long term. When the crash hits and prices fall 30, 40, 60%, you don't think, you execute. This is what billionaires do. They follow the plan they created before fear took over. Step 5. Master the psychology. This is where 99% of people fail. Because when the crash actually happens, the headlines scream disaster, fear takes over, your friends tell you to sell everything, prices fall further than you thought was possible. But this is the moment wealth transfers from the emotional to the prepared. Billionaires act when everyone else freezes. And because you prepared cash, hedges, and a buy list in advance, you can be prepared to act too. You may not have billions, you may not run a hedge fund, but you have something just as powerful. The ability to follow the same pattern as billionaires do, just with smaller numbers. The next major crash, just like each previous one, will split the people into the next generation of financially free people and the next generation of people who look back and say, "Why didn't I do something?" The question is, which group will you belong to? If you'd like to see a follow-up video covering a similar topic, let us know in the comments, and subscribe for more informative, no-nonsense explanations just like this.